Hey, what's up, guys? Hey, what's up, guys? Sam here. Kicking off the noon session for Tuesday, August 13th, 2024. Thank you. Good to see you guys. All right. So today we're going to be doing a quick macro session. I was asked to do this. I think maybe the timing is correct for one as well. So not a bad time to do that. I will be relying on you guys to some degree to ask questions if you have any. So please do not be shy about asking any questions if you happen to have any. I'll start real quick with just the markets today. And basically, the markets today are in 100% melt up mode. This is almost realistically as strong as you could possibly get. This is a 5-minute SPY chart. You can see you haven't even tested a 5-minute 21 all day, which realistically is pretty much as strong as it gets. You've actually been riding a 2-minute 21, which is just really, really kind of indicative of very strong price action, as well as a melt up type of day. So not usually price action you want to fight, especially not without any types of signals. You can see that once you have signals here and back here, it's just kind of gone with. So it makes it a little bit tough. These types of days, I think, for myself at least, are a little bit more difficult than normal volatile days because you basically have to close, kind of pinch your nose and buy it at a very aggressive level, which is something like a 2-minute 21. And even on a day like today, it's not usually a great day to do calls. Usually it's a better day to be selling premium. So be selling puts, put spreads, naked puts, things like that is usually a better way to do it because it is going higher, but it's doing it, kind of like a river of glue to the upside, but there is no pullback, right? So that's kind of the perfect scenario to be selling premium. So let's jump in over here. So again, this is a macro based session today. And as such, I got to bring you kind of the primary thing that I'm looking at. And there's really only going to be two things that I'm going to bring you that are overly macro-ish. Much of this you've already heard multiple times, but we are now getting into a point where it gets a little bit more interesting. So this is the yield curve. Again, I'm relying on you guys to ask questions. If you don't ask questions, I'm just going to assume you know exactly what this is. I'll give you a very quick rundown. And what this is looking at is the 10-year yield minus the 2-year yield. And this number should be positive most of the time. So just to give you two random numbers here, let's say it costs 3% to borrow money for 2 years, and it costs 5% to borrow money for 10 years. Right? That makes sense. It's a lot longer time to borrow the money. So you would expect to be compensated for the extra risk with more interest. When you take 5 minus 3, you end up with 2, right? Positive 2. So any numbers above this line here, all of this is positive, right? This is a normal, healthy situation. Whenever, however, you go below the lower line there, the 0 line, as there, and significantly here, these tend to be the scenarios that actually create some level of problem. So this was Japan and savings and loan. This was .com. This was, bear with me a second. So that was .com. This is the financial crisis, 2007, briefly during COVID, and then, of course, now. Now, we know what has happened in 4 out of the 5 of these, right? So we know what happened back here. Markets had a hard time. We know .com. Markets had a hard time. We know 2007. Markets had a hard time. We know 2019, which is COVID. Markets had a hard time. But the hard times for markets really only happen when this thing starts to go up, not down, right? So you can see that once you actually start to go to the upside, that's what creates the problem. My contention is that once we get past this yellow line right here, or green line, I suppose, which is the 0 level, which makes it from inverted to regular, uninverted, then that's when the problems start to occur. Okay, so I'm going to zoom in here and so you can see just we did actually you can barely see it, but it wicked right above the yellow line and now is kind of back below. That's kind of the warning shot. It is the warning shot. Now, oftentimes it doesn't actually just go, right? So something like over here where you were inverted, you went a little bit above, then you went back below, went a little bit above, and then once you go, you actually go pretty hard. I think that's what's going on here, right? Because we did actually technically cross the 0 boundary this month. So I want to show you my notes for the week because we kind of covered this. So the game plan for the week, is this the dumbest crash ever? Although the signs are there that the catalyst is off. Oh, excuse me, let me reread that. Although the signs are there, the catalyst seems off. So the catalyst being, what recently blew up the markets, which was the yen carry trade, which we'll cover just very quickly. The catalyst seems off. Watch for some central bank pivot, which would trigger a swing higher, potentially to a new all-time high. This is in the indexes. And the reason being is the yield curve signal isn't usually a go with on the first breach like it happened last week, but it will be a go with eventually. So long way of saying the shot across the bow has been made, but that does not mean that the market cannot have one last push higher before it actually historically does what it tends to do, which is big spikes out of inversion. So we covered a decent amount there. Any questions so far on any of that? So what would you invest in for the yield curve? There's 2 things that you could play. One of them would be bonds, and it would be something like TLT. And that the idea being there that interest rates have to come down, and as interest rates come down, TLT goes up. So that's a very direct way to play it. And I actually think that's one of the better ways to play it because I think there's a lot of scenarios, even if stocks go up, that bonds would still stand to benefit. The secondary way to play it would require better timing, but the secondary way to play it would be to buy index puts. Now, I don't think we're there yet. But there's 2 direct ideas. I like the TLT idea more just because it tends to work in good. The stock market could be up and TLT can be up. Stock market could be down and TLT could be up. The index puts idea would require a little bit more timing and precision, but those would be the 2 plays on it. Is plus 60 basis points an area of concern? In terms of the yield curve, no, I don't necessarily have a specific level that I'm looking at here in terms of like number of basis points difference. I'm just looking at once it actually breaks 0 and closes above it as kind of the catalyst for all of this. So I do want to be really clear about it. It technically broke 0 last week, right? But just like I said in the notes here, the yield curve signal isn't usually a go with on the first test. It's almost like it has to like just cross the boundary a little bit, and then it gets a little scared and pulls back, right? And once it pulls back, that actually gives you a rally in the market usually, right? And then eventually, Once it gets a little bit more comfortable, it then decides to push through again. And on the second test is when it does that. And that's when the problems start. But that could certainly take some time, although not much at this point, but it could take some time, maybe a couple months. And then eventually, when it is a go with, that's when you want to make sure that you're properly squared up with your risk. What would I expect for SPY and QQQ? In the near term, higher. Once the signal actually triggers in earnest that we've been discussing, then significantly lower, somewhere in the neighborhood of 50 to 60%. So it's a tough thing to convey here, because I'm telling you two different outcomes, but they're sequential. As long as the signal in the yield curve stays suppressed, which I believe it will be in the near term, markets go higher. Once the signal is no longer suppressed in the yield curve, markets go significantly lower. But we'll have time to talk about that before it happens. Okay, so I didn't see any other questions on that. I'm going to jump over to the so-called catalyst for this issue, which is the ever-loved carry trade. And then we'll wrap it up if there's no questions. So markets had a good tumble over the last couple of weeks, especially tech. And I don't think this is the ultimate catalyst for it. Again, I think this is kind of just a shot across the bow kind of thing. I think once we actually have a catalyst, we'll all collectively understand it and know it very well. But this is in part what's caused a lot of the issues here in tech. So I'm going to show it to you with the Aussie yen, which is the AUD JPY. You could look at it with the dollar yen. It's the same thing. So I'm just going to very quickly type this out. And I'm going to make it as direct as possible when it comes to what it means for trading. So the carry trade. So what is it? It's borrowing in one currency and buying another. Why would you do this? It's free money. How does that work? I borrow yen at point, I'm just going to make up a number here. Let's say 0.1%. I borrow yen at 0.1% and buy, I'm going to use the dollar here just because it's easier, and buy dollar, which pays, again, I'm just making up numbers here, 1%, right? So immediately, if I can borrow from one person at 0.1 and then turn that money and buy something else that makes 1%, you see how immediately I'm already making, let me just put 1.1 here just to make the math easy, equals free 1%. That all makes sense? I'm borrowing cheap, and I'm using that cheap money that I borrowed to buy something that yields more than what I borrowed. So it's essentially free money. What else happens? Well, I could use those dollars to buy even higher yielding assets like NVIDIA stock, right? So imagine this. Imagine a scenario in which you can borrow at basically nothing, use that money to buy dollars. Now you could stop there and make a free 1%. But you have a degree from Wharton, you're a very smart person. So you're like, well, why would I make just 1% when I can take those dollars and buy NVIDIA stock, which goes up 20% a month, right? And so now you can see the process. I borrow, and again, I'm just kind of making this up, but the process is correct. I borrow yen. I buy dollars. I use dollars to buy stock. And that all works great. And you can do that for a very long time, right? What's the risk? The risk is that the currency that you borrowed in goes up in interest rates. So if the interest rate starts to go up on the currency that you borrowed, you then have to reverse the entire process, right? Because keep in mind that these folks are really, really, really leveraged, like 50, 100 to 1 kind of crazy stuff, 20, 10, 20, 30, 40, 50x leverage. So just a tiny little move in the difference to borrow can really hurt their trades. So what's the risk? The risk is that the borrowed currency interest rate goes up. That reverses this entire process. So now, instead of borrow yen, buy dollar, buy stock, I'm now buying yen, selling dollar, selling stock. See how it just goes in reverse? And so what does that end up looking like? Well, it ends up looking like this. All right, now I'm showing you on the Aussie yen. I probably should just show you on the dollar yen just to keep things consistent. So let me do that. And so if you can understand that process, when it's working, this is a very bullish process because you're borrowing cheap from Japan. You're using that money to buy dollars. You're using those dollars to buy stock. That's adding a lot of liquidity to Nvidia and whatever your favorite stocks are. When it goes in reverse, you now are buying yen, you're selling those dollars, and then you're selling the stock. So it just basically goes in reverse. And from a chart perspective, this is what it ends up looking like. Right. So as this chart was going up, everybody was doing the same thing because you can understand why, right? It's quote unquote free money. And once this chart broke, you can compare this chart you can compare this chart dollar yen to the NASDAQ, and you can see the similarities there. So those are the two kind of major macro things going on right now. I think the carry trade will kind of shake out. I don't think that's something that would be that much of an issue. But the one issue that I would just kind of leave in your radar, and again, try to fully understand what I'm saying, or I'll try to be as clear as possible. The yield curve signal immediately in the short term can be suppressed and stocks can go higher. In the intermediate term, let's say in the next 6 months, the signal cannot be suppressed, and eventually that will lead to significantly lower interest rates. Now, when you hear lower interest rates, you might think that's bullish, but in reality, it will not be. Also, keep in mind that when they actually start cutting interest rates, that's actually historically when you have yield curve inversion, that is historically bearish, not bullish, because you have to ask yourself, why are they cutting interest rates? Right? So the timeline for it would be stocks can go higher in the short term, but once the signal actually triggers personally, and your mileage will vary, and try to play devil's advocate against what I'm telling you, historically stocks would drop about 50 to 60% once the signal triggers. So up first, then down. So that's the long and the short of it. Any questions from anyone? And of course, just to tie it all together, the ways to play it, the most direct way to play it would be TLT. Just give yourself enough time to be right. Don't treat it like don't trade like an hourly squeeze on it. Give yourself a couple of months on TLT. I think that's one of the more direct ways to play it. and I think it works in a lot of different scenarios, including the worst ones. And then secondarily, this one requires better timing, but would be something like index puts. I don't necessarily think now is the time, but we'll come back and talk about that one once the timing is a little bit better. $60,000 on the Dow before crash. That seems optimistic. I could see 6,000 SPX. Let me see what my SPX targets are. Yeah, there's a podcast on YouTube, and the title of the episode was "The Dumbest Crash Ever." I was like, you know what? That actually makes a lot of sense. It makes a lot of sense. Everybody is now an expert. Everybody on TV is now a self-proclaimed expert in the carry trade, and that usually means it doesn't work. It usually means it's something else, and in doing so, that actually provides the catalyst for a new swing higher. My biggest target and the one that I trust the most is 6118 SPX. 6118. All right, so we'll start to wrap it up there. I'll take the Apple question, but we do want to kind of keep the session. I'll stay with you guys in the essentials room for a little bit longer. We are broadcasting on YouTube as well, so I want to keep that at least focused for the goal of this, which was the macro part of it. Unfortunately, I don't know if they're asking any questions or not because I don't see it. But yeah, for the folks watching on YouTube or Facebook, we'll go ahead and wrap it there. If you have any questions on any of the stuff that we've covered so far regarding any of these notes or just how it all works, the video will be posted. So you can always go back and watch the recording or just shoot me an email at sam@simplertrading.com. So we'll go ahead and wrap up there with the folks on the YouTube. Thanks for joining us as always.